Welcome everyone to this Minerva webinar. Today we'll be taking a deep look at the shareholder voting trends and dissent in 2022. Applying Minerva's data from across the FTSE 350, we'll be breaking down the key takeaways from 2022 in the UK and looking ahead to 2023. While this briefing will be focused on the UK, please follow the sign up link below if you're interested in catching our next presentation focused on Australia. Below, you'll also find a full copy of the slides used today and several other resources used in today's presentation. My name is Alex Whitebrook, ESG Communications Manager at Minerva Analytics, and your host for today. And today I'm joined by our Senior Analyst, Thomas Bolger. Hi, Thomas.
Hi, Alex, and thanks for the introduction.
Fantastic, Thomas. Well, today I'm going to be interviewing you as we go through all of the key trends in shareholder voting, dissent, defeats, and touch upon a few other key topics before looking ahead to our predictions for 2023. Just to provide a little teaser among those predictions for 2023, I'll be asking you about the titular topic, the growing anti-ESG movement, especially seen in the US, to look at how that applies to the UK. So let's jump right into things and bring the slides up into full focus for the audience. And a quick reminder to everyone as well, if you have any questions for Tom or myself, please submit them below the video. Minerva's analysts collected a wealth of voting data in 2022, allowing us to put together the headline statistic here. Our analysis covers 348 of the UK's largest companies and a total of 432 shareholder meetings, as several companies held a non-AGM during the year, such as a general meeting, a court meeting, etc. These 432 meetings brought about a total of 6,724 resolutions, of which 12 were not voted on by shareholders due to either the resolution being withdrawn ahead of the meeting or due to the actual meeting being adjourned by the company. Among the many resolutions put before shareholders, this year saw an increased number of shareholder votes on climate-related resolutions. Social issues, especially diversity and equity, also emerged with renewed importance. We'll cover these specific issues a little more later. But first, Tom, with all these important issues gaining greater traction in the UK market, how did shareholder turnout shape up?
So, Alex, what we've seen is that whilst there was a slight dip in turnout at UK AGMs in 2020 and 2021 due to the coronavirus pandemic and its travel restrictions, self-isolation and self-distancing rules. However, there is now somewhat of a return to normalcy in meetings, and companies and shareholders at the same time have also moved towards online participation in meetings. So what we have seen is turnout appears to be back on its previous upward trend seen in the pre-pandemic years. You can really see this trend when you look at the median turnouts. But on the issue of online participation, there's still debates over the use of online participation, and in particular the use of virtual-only meetings, and companies do need to provide a good explanation as to why such a meeting format is considered appropriate, and also ensure the technology chosen to facilitate the virtual meeting ensures the democratic access for all participation and open dialogue between shareholders during the actual meeting. So hybrid meetings, which combine both a virtual and a physical format, are still seen as best practice by investors.
Thanks, Tom. It certainly is a good trend, in my opinion, to see much greater turnout at AGMs in recent years. What do you think could be ultimately driving this change?
Well, I think the increase does link back to that easing of coronavirus restrictions, and that then because of this, we've also seen return to the upward trend seen before the pandemic. So it's more getting back on track what we were seeing before. At the same time, there's also greater expectations on institutional investors these days on fulfilling their stewardship duties and acting as active owners, and in particular in regard to proxy voting. And there's also greater access to voting through technological developments at the same time.
That's a really good point, actually. We're living in a very different world today. We at Minerva know better than most that the technological improvements have really improved the active ownership that shareholders can have over their investment. So it's really good to see. Now, moving on to the big topic of dissent, we can see that this chart has changed somewhat since we did our breakdown at the end of peak season last year. Overall, dissenting votes being against management recommendation has seen a slight drop in top UK companies this year, according to our recorded average, which stands at around 2.9%. What do you make of the year-on-year decrease in high dissent?
So first, just to go back to what we actually mean when we talk about shareholder dissent and also high dissent. So Minerva calculates dissenting votes as votes not cast in favour of management recommendation. So if management recommend a vote in favour, we consider how many votes were cast as an abstention or an against, i.e. the proportion of votes against management recommendation as dissent. And then a high dissent resolution is classified as a resolution that receives 20% or more dissent, and that's the threshold used by the UK Corporate Governance Code. Although Minerva does consider a 10% dissent outcome to suggest underlying issues that should be looked at and addressed by companies and also shareholders. I think we can see that the fall in average dissent is part of a cycle that appears to be shown in this 10-year figure trend, which we have in the graph here. So we see both upwards and downwards trends over time. But at the same time, the median this year has increased, however. But it could also be that this fall in dissent these last 2 years is a sign of improved stewardship and also engagement between boards and shareholders, with issues being nipped in the bud before they actually get to a vote. But we've also tended to see that shareholders are picking their battles recently, so this results in a small number of high-profile significant dissent levels, but actual low overall dissent levels.
Now, moving on to high dissent specifically, which you covered the definition of really well just now, we've seen 141 resolutions receive such high dissent this year. That's about 2.1% of all resolutions and a fall from the 2.6% that we saw last year. As usual, the majority of resolutions which received high dissent were regarding remuneration and board members. So what further analysis has Minerva taken from this year's high dissent votes?
So in terms of the highest dissenting resolutions by category, we can see that the governance resolutions still dominates, but the E and S for environmental and social issues can be controversial and also contribute to the governance-related vote outcomes. So board-related resolutions, and in particular director elections, constitute the largest source of high dissent resolutions. But this is actually in part due to the fact that in the UK market, directors stand for election on an annual basis, which means the majority of resolutions voted on at UK AGMs are board-related. So the actual dissent on board resolutions was actually only 2.81%. So while it's the highest count of dissenting votes, the actual dissenting votes only accounted for 1.56% of board resolutions overall. And there's also a range of factors for why shareholders may vote against a director. These can include governance factors such as independence concerns, overboarding, or concerns with, say, the gender composition of the board. But we're also seeing investors holding individual directors accountable when there's concerns with ESG practices. This could be a lack of clarity in how the board oversees the management of ESG-related risks and opportunities, or if a ESG controversy has been identified at the company. So an obvious high-profile case that we've discussed in previous webinars is the dissenting votes cast at Rio Tinto due to the firm's destruction of sacred rock shelters in the Juukan Gorge in Australia, where some directors received a very high dissent votes when that occurred. And similar to this, remuneration is also increasingly being seen through an ESG lens, and in recent years, board decisions around executive pay have been very closely scrutinised by shareholders during the pandemic. And that's because in a situation where many individuals have suffered a major personal loss or a financial cost, boards need to think carefully about getting remuneration decisions correct. So getting the approach to remuneration for directors and different stakeholder groups wrong can cause reputational damage and also risk shareholder dissent. And with the current cost of living crisis, the notion of pay fairness and the need for remuneration committees to balance the need to incentivise executives whilst also ensuring their experience aligns with shareholders, employees and other stakeholders will continue to be an important issue. So diving deeper into these high dissent resolutions and remuneration votes, here I prepared the top 5 remuneration resolutions by dissent. So there are 3 remuneration reports defeated in 2022, although 5 did actually receive over 50% dissent. So both Greencore and WH Smith received over 50% dissent, yet they both passed. And that's because abstentions are not actually counted as a vote under UK law. So when excluding abstentions, the number of votes cast in favour exceeded the number of votes cast against. And this highlights the potential issues of abstaining when concerns are held by a shareholder. And say the Pension and Lifetime Savings Association's voting guidelines, for example, do actually suggest that if shareholders have concerns with remuneration, they should try and avoid an abstention and actually vote against in order to ensure that companies get the message, and also given that the vote is only advisory. So at both WH Smith and Greencore, the key shareholder concern was the decision to pay annual bonuses to executives despite the companies benefiting from government furlough supports during the year. And this links back to the trend that we identified earlier, that remuneration is increasingly being viewed through an ESG lens, and social factors regarding employees and stakeholders have been impacting vote outcomes. And I think this is an issue that isn't going to go away in the context of cost of living crisis, rising inflation, and many UK workers suffering a pay in real terms, which brings back questions over responsible business, pay fairness, and the impact of ESG risks on sustainable value creation. We're also seeing more companies now incorporate ESG metrics into incentive pay plans as well.
Yeah, that's really insightful analysis, and I tend to agree with the fall in pay in real terms and the ESG lens on remuneration. It's not an issue that's both of these are not issues that are going away anytime soon. In fact, the fact that all top 5 highest dissenting resolutions are remuneration reports is a clear sign of this trend. And if we zoom back out to the topic of defeated resolutions in general, how did 2022 shape up in that regard?
Well, Alex, so in 2022, we saw overall 12 management proposed resolutions defeated, i.e. voted down by shareholders. But here it's worth highlighting that the capital, corporate actions, and also shareholder rights resolutions all were proposed as special resolutions and therefore needed a 75% vote in favour to pass, rather than an ordinary resolution which requires a 50% majority. So in these circumstances, it means that it actually takes fewer shareholders to vote down a resolution, or a major shareholder can have a significant say on the outcome of a vote of a special resolution. So compared with 2021, there have been less defeated resolutions in 2022, and the number of remuneration defeats has also declined. But this could also be that this year boards have been more aware of shareholder expectations on the responsible use of discretion to align executive pay with the stakeholder experience. Additionally, the easing of COVID restrictions, they've also shifted focus to ensuring companies actually retain and incentivize executives with the right remuneration structure during this post-pandemic recovery as we build back better. But shareholders still will want to pay close attention to the alignment of pay with performance. In particular, they will need to make sure that executives do not receive windfall gains due to wider market movement rather than company-specific performance, particularly at a time when there's fluctuation and uncertainty in the markets. But when we're talking about, say, the higher level of defeated resolutions last year, that was also impacted by the shareholder battle for the composition of the board and future direction of Petropavlovsk, which had 9 resolutions voted down at its AGM alone.
Interesting. And that goes back to what we talked about earlier on more engaged and active owners potentially nipping things in the bud before they get to a vote. So we have discussed the decline in overall dissent and the number of defeated management resolutions here. But what has been happening in regard to shareholder proposals specifically? They have dominated discussions in the US market, for example, but it appears to have been somewhat quieter in the UK.
Well, so what we have seen in regards to shareholder proposals is that social and environmental related proposals, and in particular climate change, have dominated the headlines of late, although much of the discussion has centred on the US shareholder experience, as you stated here. So the experience in other markets is different, and says generally less proposals filed and also less successful voting outcomes. And this is particularly the case in the UK market, where the filing of resolutions is much less of a feature in engagement and stewardship. So in the UK, shareholder proposals voted in 2022 all focused on these social and environmental issues, namely workforce-related issues being the living wage, foundation accreditation at Sainsbury's, employee pensions at HSBC, and also proposals on climate change targets at Standard Chartered, BP and Shell. But as you'll see here, that none of these proposals actually received votes in favour of 20% or more. And this kind of like lower level of support on shareholder proposals has been something which we've seen on a global basis this year, this decline. And I think there's several reasons for that. So there's been changes in the US Securities and Exchange Commission legal guidance on shareholder proposals, which has resulted in less proposals being excluded by boards, and also new types of proposals and more proposals being voted on in the market than ever before. At the same time, shareholders have been emboldened by the success last year, which has resulted in more ambitious proposals filed this year. So on climate change, there's been more requests for targets and policy rather than proposals seeking greater transparency. And this has also resulted in more sustainability-related proposals filed than in previous years. And these first-time proposals do tend to receive lower levels of support until, say, boards and investors become a bit more comfortable with them. As well as that, there's some institutional investors which have clarified their voting approach on proposals that are considered too directive or are seen as micromanaging the board on strategic decisions, such as these policy requests. And at the same time, on climate change proposals, which have been a key focus for shareholders recently, there's also been a different political and economic environment this year, with the war in Ukraine and the crisis in the energy market impacting voting decisions around climate strategy, and also the need for markets to ensure short-term energy security.
Those are all pretty spot on. Although I think it's interesting that you point out first-time proposals receiving low levels of support. Has this also been occurring in climate-related resolutions, whether proposed by management or shareholders?
That's an interesting question, Alex, and I think we can separate the answer into two different discussions here, one on shareholder proposals and the other on management-proposed shareholders. So, as mentioned, there's been more ambitious climate proposals filed by shareholders. And taking this first-time proposal view, so in the US and Australia this year, a number of banks and insurers have received proposals on policies on the financing or underwriting of new or expanded fossil fuel projects, and these have tended to receive low levels of support. So in the US, these proposals have received on average only around 10% support. So this might be in part due to being a new type of proposal they represent, but also due to the more directiveness of the proposals. And other established proposals that seek enhanced reporting on climate risks rather than policy have received greater support. Whilst then if we move on to management proposed, say on climate votes, that's votes to approve a company's climate transition action plan, there has actually been a fall in support for climate resolutions compared to last year. So 2021 was the first year to have a management proposed saying climate resolutions. And it does seem that based on the voting results, companies were being rewarded by shareholders for being first movers on this for their adoption and commitment to transparency and engagement on climate issues. But in 2022, there has been a small but significant drop from over 90% support last year to around 76% in the UK. So another factor potentially influencing this decline in support could be that last year, with companies being rewarded, but it could also be that companies with a greater preparedness for climate reporting were actually among the first movers. So their reporting and their plans were already stronger, say, than the companies which started putting proposals this year, which have resulted in a higher overall dissent level on these votes.
It's quite the drop, really, year on year. I know you referred to last year there, but I know that you mean 2021 when you say last year, because I believe that was the figure that you were comparing to. Is that right?
Yes, it is. So yeah, last year,
exactly. Last year is in
season.
Year before last. But that's fine. That's fine. I do look forward to hearing more about how things will change in this regard with climate now that we're in 2023. But before we do move on to the predictions for this year, I'd like to just point out that all of the analysis provided in this presentation today is available to our clients via Minerva's VoteWatch platform, an online voting results dataset for querying and screening voting results data going back over 25 years. Our platform is mostly used by asset managers and asset owners, but even academics, to understand the voting trends of the past few decades. And if anyone here would like to have a demo of the platform, please do get in touch with us after this webinar. Now, Tom, what would be your most important predictions for shareholder voting trends in the UK's top 350 companies going into 2023?
So the first prediction is something that you and I have actually discussed during our peak season review earlier in 2022, which and we've already mentioned that folks at Sainsbury's over the Living Range Foundation, which received around 16% shareholder support, which was a resolution which the management actually opposed. While this doesn't constitute high dissent, Minerva has taken an in-house view on anything over 10% dissent as being a sign that effective stewardship and engagement did not resolve the issue before it came to a vote. So this proposal, we think, and the results, does represent a continuation of a push towards greater social activism by shareholders and an increased focus on social issues. So climate has dominated the conversation for a number of years now, but it certainly should be that the social issues will be focused more going forwards and are being picked up in shareholder resolutions. And it's not just in the UK, but also in the US, which we've seen a number of proposals on, say, racial equity audits receive large votes in favour. And then going back to the UK, the Department for Work and Pensions set up a task force on social factors in 2022, which supports this view that social issues will become a more important area for both companies and shareholders going forwards.
Excellent. Thanks, Tom. And I think you mentioned the racial equity audits becoming more of a hot topic in the US. We are talking mostly about the UK today, but the US is obviously unavoidable in this discussion. And we have included Minerva's racial equity audits short briefing down below, in which you did some fantastic work and analysis. Moving on. So do you believe that there will also be a greater stewardship efforts to avoid such high profile shareholder resolutions gaining support in the future?
Well, it's certainly one possibility, and there are many companies, say like Minerva, out there helping to improve the stewardship efforts of asset owners and asset managers, but it does remain an uphill battle. There will always be issues that shareholders and issuers disagree over, but communication between all stakeholders is an improvement, as also disclosure and also compliance requirements grow in the markets.
Speaking of growing regulatory requirements, biodiversity is another area that's been rising up the ranks of importance in the last year or so. In fact, biodiversity was the first topic that Minerva held a Bright Talk webinar on back in 2021. And I've attached the link to that webinar in the documents as well below this video if anyone wants to take a look. It's a good one and very relevant to today's discussion, talking about the future of shareholder voting in the UK. But anyway, how is this topic of biodiversity likely to evolve in the coming year?
Well, Alex, that's an interesting one because 2022 actually did end on a high note for biodiversity, with the United Nations agreeing to the Global Biodiversity Framework, or GBF for short, on December 19th. So this is a landmark decision that the world has been waiting on for a while now. And after COP15 on biodiversity was delayed for several times due to the COVID restrictions. So the GBF is a list of 24 recommendations to governments on how to legislate for biodiversity, which has been agreed upon. And this could spark the calls for greater action throughout the global economy, much like, say, the Paris Climate Agreement did for action on climate change. So in anticipation for this new biodiversity regulation, Minerva does expect to see the topic popping up more at general meetings in the coming year, and this is only amplified by the fact that the Task Force on Nature-related Financial Disclosures plans to publish their final recommendations for companies and investors in September 2023. With that said, though, the fact that these recommendations are being published towards the end of the year will mean that a big uptake of the recommendations may not actually be seen until, say, 2024 or 2025 at the latest.
I'd have to agree with you there. I think we saw the same pattern with the TCFD, the Task Force for Climate-Related Financial Disclosures. The Paris Agreement came along in 2016. It wasn't until later in 2018 that owners and managers of listed equity had something more catered to their needs found in the TCFD. I think it's likely that the TNFD may go through a somewhat awkward phase as the market figures out how to take the recommendations on board and implement them. But coming back to climate, what do we expect to see on that front in 2023?
Well, this is one we covered in our review at the end of peak season last year, and it's obviously the big question on everyone's mind, but it's quite simple when it comes down to it. You and I have actually already discussed the trend in 2022 towards a harsher assessment of saying climate resolutions and an increase in dissent. So although we expect there to be an increased number of saying climate votes moving forward into 2023, it's highly likely that shareholders will once again be more discerning with their votes and not so easily approve company climate transition action plans, although we have not yet actually seen a climate plan voted down by shareholders as of yet. But at the same time, climate activism may also be expressed through votes on director elections. Particularly, say, disapproval could be expressed on a director considered to be accountable for ESG or the management of climate change risks. And that's an effective stewardship approach to take by combining a vote against the climate plan, but also holding a director accountable.
Good points. I think a key takeaway is that it's not just company proposed say on climate resolutions that will face higher expectations from shareholders, but any climate related actions or lack thereof by the company. It'll be interesting to see how the movement develops in the year ahead. I'm sure we'll also see many more shareholder resolutions on the topic. But another movement that we've all been keeping a close eye on in the past year is the anti-ESG movement developing in the US. This is a big one, and obviously the titular topic mentioned at the top of today's webinar. Anti-ESG policies have come into effect in a number of US states in the past year, including Arizona, Texas, and Florida. These states have passed laws that limit public entities from investing in companies that adhere to ESG policies or require additional disclosure of ESG policies. At least 8 other states, to our knowledge, are considering similar legislation, and a number of prominent companies have come out against ESG policies or adopted policies that are opposed to them in some way in 2022. The US Department of Labor has actually also been active in this area, issuing a proposed rule that would limit fiduciaries from investing in ESG funds unless they believe the investment is economically beneficial to the investor. So they have to show that material link of ESG. Given this growing movement, this rapidly growing movement in the US, what do you think the future holds for the UK market?
Yeah, this is obviously a big topic at the moment, Alex. So I think in the UK, skepticism of ESG ratings has existed as long as they've actually been around, with some investors questioning the accuracy and also the reliability of the data used to calculate them, and also the contrasting ratings provided by firms on the same company, and also the various different methodologies used. So more recently, the Financial Conduct Authority has taken steps to ensure that ESG ratings are more transparent and accurate, issuing new guidance in 2020 that requires firms to disclose the methodology that they use to calculate their ESG ratings. But this skepticism is very different to the politically motivated anti-ESG movement that we see in the US. So in the UK, shareholders have actually been demanding greater transparency in how companies measure their ESG performance. And this has in turn resulted in stricter regulation of ESG reporting by companies. And this is only working to strengthen ESG investing and also fulfill the wishes of shareholders who want this reporting and data. So in the US, though, we've actually also seen the rise of what some have been calling anti-ESG shareholder proposals. And these are resolutions filed by shareholders which tend to use the same language as other shareholders, but they actually have a different underlying request, which is more politically motivated. For example, it could be a proposal on board diversity, but rather than focusing on, say, gender and ethnic diversity, which is the normal focus, it calls for greater ideological diversity on boards. But these anti-ESG proposals have so far received very low levels of shareholder support. But at the same time, whilst this growing anti-ESG movement in the US, the Securities and Exchange Commission are actually looking to introduce new reporting requirements for companies on the various different ESG issues such as climate risk, human capital management, and also remuneration. So in 2023, the debate over ESG is likely to continue. And considering all of the data that we've discussed here today, And although there is the way things are trending in the US, I'm not sure whether we'll necessarily see anti-ESG sentiment growing the same way in the UK. In the UK, we're more likely to see, say, a crackdown on investors that can't demonstrate their claims on ESG, as regulators look to crack down on greenwashing, which is a slightly different focus here. So as the title of this webinar hints, we are rapidly approaching a crossroad for ESG. So companies do need to work on improving the accuracy and transparency of their ESG data. Investors must continue to engage them on this front if ESG investing is to retain its legitimacy, and also demonstrate how they are fulfilling their statements on being an ESG investor. And at the same time, we're also seeing organisations such as the PRI trying to shift the focus more on engaging in systemic ESG issues and also encourage real-world outcomes. And there's also organisations pushing for greater standardisation in international reporting on the ESG-related issues. So this debate over the future of ESG is a big topic at the moment.
And it's certainly far from over. Brilliant words of warning, Tom. Are there any specific regulations that you believe investors will need to watch out for in 2023 that will force companies and investors alike to raise the bar?
Well, at the moment, this is a rapidly moving area. So there's so many regulatory ESG developments to go over, but just for today, I'd say the biggest development on that front to look out for 2023 is the UK government's consultation on regulation of ESG ratings, which is set to be published in the first quarter of this year. But the results of this consultation will have a huge implication for company ESG reporting and also therefore on future AGMs.
Brilliant. Now that ends Minerva's review of 2022 voting trends in the top 350 companies in the UK and our look ahead to 2023. Thanks for all your useful insights, Tom.
Thanks, Alex. It's been great to discuss all these interesting topics today.
Before we wrap up, I must mention that with the growing importance of ESG, Minerva is well positioned to provide you with all your proxy voting and stewardship needs. We are connected and knowledgeable when it comes to responsible and sustainable investing, being a signatory of the 2020 UK Stewardship Code and a founding member of the industry-leading Net Zero Financial Service Providers Alliance. We've also been widely awarded as leaders in sustainable investment solutions. You can contact us via hello@minerva.info if you're interested in hearing more, or you can reach out to me directly at alex.whitebrook@minerva.info. All of this information, again, is included below this video. Also down below, you'll find today's full briefing and slides. You can find the sign-up link to our next webinar, which will cover shareholder voting in Australia in 2022 and a look ahead to 2023. Another area where Minerva is certainly ready to help. We are also currently in the process of producing a briefing on shareholder proposals and one on workforce disclosure, so do follow our socials or subscribe to our newsletter to hear when those are available.